you see that everything in the universe goes in cycles. It's basically a sine wave, and so straight lines don't last very long. And right now we're in that part of the long-term cycle, the secular cycle, which is the bad part. And in the early 2020, when everybody was making their forecast for the decade, not for the year, they said, well, if you want a similarity, it's going to be like the 1930s. Look at what happened in the 1930s and look at charts, not just that it was 10-year depression. You have to look at what happened inside of that depression, the big ups and the big downs and so on. The Dow went down about, 90% until the 32 bottom, but then it doubled, and so then it went down again 37 to 1942, was cut in half. And so, these are challenging times, and it's going to be like that. You need the best guidance.
So what does your picture say about the credit crisis?
Well, I think in a way, short term, the banking crisis that we saw in March actually did what the Fed refused to do, money. And here's the great fiction on financial TV. They call raising interest rates tightening money. That is as false as it can be. And I explained that in 1978 when the head of the Federal Reserve, a new guy, he said, we're not going to fight inflation with tight money, meaning loan restrictions. We're going to do it by raising interest rates. And then Paul Volcker came in 1980, and he said, we're going to tighten money. So not just raise rates, but tighten the availability of money. That's it. He's going to kill inflation. And of course, it's going to be very painful. But now we want to get out of gold. We want to get out of the commodities. This is the end of the inflation. Banks are not lending. Okay, right. They're basically, new loans are basically zero. Okay, this is the tightest money we have seen. In fact, it's on record. If you go back to the 1930s depression, this is the biggest tightening of credit that we have seen since the Great Depression. No bank is making loans. Okay, either because they don't want to take the risk of new loans, not getting the money back, and second of all, because their deposit outflow. They've had hundreds of billions of dollars of deposits flowing out. It's the biggest outflow of deposits on record, which then look at the ripple effect. Now that causes a decline in the money supply M2. We've now had the strongest decline in money supply M2 since the Great Depression. When you look at these numbers, you say, hey, this is going to be not a soft landing. There is something much, much worse ahead.
Isn't the sign that they don't want a loan, that they're worried about getting paid back? Isn't that a sign that they're very, very concerned about the economy and what's happening?
Yes. One is that even banks who do have the money, they do have enough money at the Federal Reserve called bank reserves, but they don't want to lend it because they don't want to take the risk of not getting the money back. That's the one. That's a better case. But the other banks say, we can't, we don't have the money. It will all flowed out with the SVB crisis. And, can you imagine there, in 6 days, we had 3 of the biggest banking failures, except for Lehman Brothers, in the history of this country. In 6 days. Nobody really makes a big thing of it. Oh, that was a one-off, SVB. They made a mistake and so on and so on. No, this is the tip of the iceberg. In Europe, Credit Suisse, the largest bank in Switzerland, and nobody ever thought that could fail. I think it was in existence 137 years. It failed. Within a few days, boom, suddenly it went from being a functioning bank to being out of existence.
I was at Bank of America right down the street from me in Camelback, and one whole end of the building was empty, Bert. It was the loan department. The loan department used to be just packed with people. It was empty. So this is the big picture, the macro of it. The dollar or most fiat currencies can only exist if people borrow. So by not offering credit and people stop borrowing, that's not putting gas in the car.
I think that's totally correct. It is downplayed so much on financial TV. We've got about $1.5 trillion worth of commercial real estate debt coming due by the end of 2025. That's not far away. That means it has to be refinanced, or the lender is going to have to extend the terms, which a strong lender can do. Timing is everything. And people should not get the short term mixed up with the long term. That's so important, especially right now. The Federal Reserve officially says they're still fighting inflation. Okay, so it means they want to demonstrate that they're fighting inflation, so they may increase rates another 0.25% and so on. But this is just for show. Okay, when the economy, the actual shrinking process that's going on right now, when it starts showing up in these statistics, then the Federal Reserve is going to say, okay, now we have the cover to stop hiking rates, and then the next step is cutting rates. So that first part is where we are now, the fake out, basically getting every optimistic, the banking crisis is over and all that stuff. That's the short term. Then that is followed then by the talk that the Fed is going to cut rates. That's another little boost in the market, maybe for a month or two. And then you get the reality, and that should come full swing probably in September of this year, when suddenly the true statistics are released, like the Bureau of Labor Statistics from the government that publishes the employment numbers. In January, for example, they said 517,000, that's a lot of new jobs were created. And I said, that's impossible. In January, you always have a drop because of temporary workers. People should look at history. At the beginning of 2020, I said this is going to be like the 1930s. And so look at the stock chart of the Dow Jones starting in 1927. I think we have it in this issue that we're giving to people. And it goes to 1954. And it shows you what happened in the market. We are now, you had this crash, 90% down until 1932. Then you had the big rally, it retraced about half of that loss, okay? And in my opinion, if we're looking for similarities, we are now exactly at the top of that bounce back that we had in 1933, okay? And from there, you could see it. It's a straight down drop in the market. It's really incredible how this worked out. So you had the first down leg, which we had 2022. Then you had the rally, which is now topping out. And then you have the real serious drop. So that's why we look at charts all the time. I think the most important thing is that instead of saying it's bear market, I'll go away because there's no way to make money, that's wrong. Bear markets have always been very, very profitable for us and for our valued subscribers. Bear markets offer opportunities because you don't have the masses with you.
Your profit is made when you buy, not when you sell.
That's right.
And the time to buy is here. And the other part about this is human nature is what people do is they wait for the price to get to the top, then they buy, then it crashes, and they say, oh, the stock market's blah, 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 blah.